Hello everyone, I am CS Ujjwal Pahava. Welcome to another episode on commodities. In today's video, we will be discussing the role of commodity trading in diversifying your investment portfolio. If you want to be a successful investor, you need to learn how to diversify your portfolio. You must have heard of the adage, don't keep all your eggs in the same basket. Yes, you should spread your risk across different asset classes to protect your portfolio from market fluctuations. While stocks, bonds, and real estate often take the spotlight, commodities can be a powerful tool to enhance your investment strategy. And so today, I'm going to talk about why should you consider including commodities in your portfolio. First, let's talk about risk management. Some commodities may have negative correlation with the stock markets. What this means is that when the stock market is down, commodities might not be, or they might be even up. For example, during times of economic uncertainty, gold prices often rise as investors seek a safe haven. An example of the situation was seen during the 2008 financial crisis. While global stock markets were plummeting, gold prices surged. By including commodities in your portfolio, you can potentially offset losses in other areas, thereby stabilizing your overall investment returns. So this means commodities can help you to offset losses in other asset classes, reducing overall portfolio volatility. One of the key benefits of adding commodities to your portfolio is inflation hedging. When inflation rises, the prices of goods and services increase, and so do the prices of commodities. Investing in commodities can help preserve your purchasing power during inflationary periods. Historically, commodities have tended to perform well during inflationary periods when the value of money decreases. Commodities can also offer exposure to global economic growth. Now, let's look at how you can invest in commodities to diversify your portfolio. But before that, please understand that while commodities can be a valuable addition to your portfolio, it is important that you should know the risks involved. The prices are highly volatile. It's better you know your asset well before investing in it. Different factors affect different commodities, and thus mitigating risk while dealing in commodities can be a different affair altogether. We have discussed this commodity by commodity in our previous videos. You can check them at our channel. So there are several ways to invest in commodities. One common method is through commodity futures, which are contracts to buy or sell a specific amount of a commodity at a predetermined price on a future date. This can be done through exchanges like Multi-Commodity Exchange in India. Another way to invest in commodities is through commodity-focused ETFs and mutual funds. These funds pool investor money to buy a diversified portfolio of commodities, making it easier for individuals investor to gain exposure to this asset class without directly trading futures. You can also invest in stocks of companies involved in production and distribution of commodities, such as mining companies, oil and gas firms, and agricultural businesses. This approach allows you to benefit from the commodity price movements while also gaining exposure to the growth potential of these companies. To conclude, by including commodities in your portfolio, you can manage risk, protect against inflation, and potentially enhance returns. Whether through futures, ETFs, or company stocks, there are multiple ways to gain exposure to this dynamic asset class. If you are interested in learning more about investing in commodities, don't forget to check out our series of videos on commodities. I'll see you in the next video.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.